A big question on people's minds currently is whether to take out a fixed rate mortgage or a variable rate mortgage. And part of the dilemma is because they are at different rates. So with a fixed rate mortgage, you're generally going to pay a bit more. With a variable rate, you're going to pay less. However, the benefit obviously of a fixed rate mortgage is that you are secure in knowing for a period of time that you are going to be paying that amount no matter what happens in the market. Whereas with a variable rate, of course, that can fluctuate. And for me, it would always be a fixed rate. Now, when I first bought my first property, there was no such thing as a fixed rate mortgage, and I was kind of envious at that time of the American system because they actually allowed you to have fixed rate mortgages or variable rate mortgages. And so I would have definitely opted for a fixed rate mortgage, even though at the time of taking out the mortgage it would have cost me more. And particularly because my first purchase was during the early 1970s, 1973, and of course we went through very rapid inflation. Inflation climbed to 25-30% by the mid-1970s, and towards the end of the 1970s, in fact in 1979, as I will just show you here, you will see that the bank lending rate went up as high as 17%. Now that was the base lending rate, which meant that the mortgage rate was far in excess of that. In fact, I believe, although I can't quite remember because it is a long time ago, it was 21%, so there was a 4% margin that went on top of that 17%. So a crippling interest rate. Now, had I been able to fix that rate, and when I took out my first mortgage, it was already above the 10% mark, even in those days. And so I think I was paying, like I say, 11.5% mortgage rate, which seems inconceivable today. But had I been able to fix it at that rate, then I would have saved myself a pain. In fact, I didn't actually suffer an awful lot of pain because I had a relatively small mortgage and I had a very large loan to value, so it didn't really affect me that much. But you can imagine that if I was pushing it up to the limit, then in fact it would have been very, very difficult. Now, part of the reason it didn't really impact me was because I actually rented out rooms in the house. So I stayed in one room. I was young, I didn't need all the rooms, didn't need a large place, and I was able to rent out, so I was gaining some income from there. Now, this is prior to buy-to-let mortgages. There was no such thing available there, and in fact, in a certain sense, had the building society known, and they were the only people who lent money in those days, not the banks, then they would have not been very happy with that situation because they didn't see themselves as commercial lenders. They saw themselves purely lending on residential homes. So I'm sure in their terms and conditions, in fact I know in their terms and conditions that you weren't actually allowed to do that. However, I kind of bended the rules, I guess. There was no other available product. Anyway, coming back to whether you should go for fixed or variable rate, I would certainly definitely go for a fixed rate. Now, I'm giving you my opinion. I'm not advising you because clearly individual circumstances are different and you have to make your own decision and take your own financial independent advice in that respect. But the reason I would definitely go for a fixed rate is because we don't know what's going to happen in the coming years in terms of inflation. Now, if you've watched some of my other videos in terms of the property cycle, I see an almighty crash coming in 2026, and I think there's a lot of things building up to that. A lot of people think it's going to come a lot earlier than that. I don't. I actually believe it is going to play out until then. We're in the early part of the second cycle, and we are going to see a lot of growth. We are going to see inflation. At the moment, currently, the bank it's just been announced that we've reached over 5% inflation. Now, for a lot of people, that seems an extraordinary level of inflation because we've had very, very low inflation. The problem with inflation, and this is what I witnessed in the 1970s, is that once it really gets a grip, and part of the reason we've had low inflation up to now is because we haven't had wage inflation. So we've had price increases, so we've had price inflation, but we haven't had wage inflation. We now have wage inflation, and that's okay as long as the wage inflation it doesn't then become an upward spiral, because that's what happened in the 1970s. So prices would go up and then wages would go up to compensate for that. Now, wages in themselves going up is not a bad thing, because we want to have a higher wage economy. The problem is if you get wage increases that don't have then productivity attached to that. So, for instance, let's assume that we have a process that takes 10 people, and that process it then becomes more expensive because the wages then go up in that particular process. However, if we can make that process much more efficient, in other words, we can increase the output maybe through some automation, and so now we have twice the amount of output for the same 10 people, and their wages go up by 50%, then that works okay, because what we've done is we've increased the productivity. The problem is that if we don't have increases in productivity to match the wages going up, then that will feed into inflation. And once it gets above a certain level, it becomes very dangerous. So as we saw inflation starting to creep up in the early 1970s, we never expected it to go up to the heavy and heady levels that it went up to. So there's always that danger. And one of the ways that banks will curb one of the ways that government and banks will curb inflation is to take money out of the economy, and the way that they do that is through raising the bank lending rate, and so therefore that can then spiral and have a dramatic effect. So you can imagine if you were currently paying maybe 3 or 4% on your mortgage, and suddenly it went up within even a 12-month period up to 10%, what impact would that have? And of course, the other thing that's happened since we had those higher rates, and one of the reasons that it was affordable was because we had much lower affordability ratings. So traditionally, when you went for a mortgage, you would only be able to get 2.5 times your income as a mortgage, and so therefore you weren't so exposed. And indeed, during those times, if you were married and your wife, so in other words, the husband could get 2.5 times, but the wife could only get 1 times their qualifying mortgage amount. And of course, there was obviously very strong opposition towards this, and women wanted to be treated equally, naturally. And what that actually had the effect of doing, unfortunately, was driving up house prices even further, because the more people can afford, the more it drives up house prices. And that's kind of where we are now, because we have a much higher multiple, and that higher multiple means that we've borrowed a lot larger sums of money, and therefore an interest rate hike on those is not really taking into account those higher multiples. In other words, if you had a 2.5 times salary multiple and interest rates go up, then it wouldn't impact you so severely, as opposed to having a 4 or 4.5 times multiple, because you're dealing with a much larger amount. And so again, for me, that compounds the fact that I think a fixed rate is definitely a worthwhile insurance policy to ensure that you are at least secure for a period of time. Now, depending on what period you can fix it for, will depend on the product that you choose. But assuming that you could take one out for 5 years, 5 years gives you an awful lot of time to be able to react to that situation, as opposed to a rate suddenly going up and being dumped upon you, and you have very little time, a month, to react to that situation. So I hope that you've found that kind of useful. It's kind of a bit different from what I would normally talk about, because my main remit is property development, and I'm involved in property development. Incidentally, I'll just give you a plug. We are about to launch the Find It course at the beginning of next year. This is the full digital course on how to find off-market land, properly evaluate it, and secure yourself a really great deal. As property developers, one of the key skills that you need to have is the ability to find land. And in fact, you don't even need to build out the land, and you can make some substantial profits. So that course has been going through lots of iterations, because I've been working with people on a pilot basis up to now, but now we're about to launch the full course. So if you'd like more information on that, then visit our website, builditandprosper.com, and you can currently register for our 50-minute land breakthrough training, which we will be holding the last one of in the beginning of the year. And I think that's going to be, if I just look at my calendar, is going to be, I can't see it because I've got a 2021 calendar. So anyway, I'll put, when I edit this video, I'll put that up on the I'll put that in the description, and I will also put it up on the screen. Anyway, take care. I wish you a safe time at the moment. I know things are becoming a little bit crazy at the moment, and people are some people are very nervous about the current situation. Other people feel very relaxed about the situation. So whatever you feel, I hope you stay safe, and I look forward to speaking to you in the next week, which will be the last video before Christmas. Take care. Bye bye. Thank you for watching. Subscribe for more videos, then click to watch the next video. Please remember to visit our website at builditandprosper.com, Together app, or click on the button on the YouTube header if you're on desktop.